In this video, we are going to talk about proof of performance. When it comes to whole life insurance, a reality that exists that not many people want to talk about is policies typically underperform, meaning people open whole life insurance policies, they're interested in the cash value, they look at that illustration, and then the actual results are just less and less than what was projected every single year. And people get disappointed, say whole life insurance stinks, why would anyone ever put money here? And we can go on and on about that. But at the same time, we do see whole life insurance policies that actually deliver strong cash values and people love their products. We talk about banks, corporations, wealthy individuals, positioning money there all the time. But where's the actual proof of performance? Well, if you work with our company, you have access to our actual historical performance playlist, which goes through all policies from 1975 up through 2021 that have lived the test of time, and not the projected performance, but the actual results. Now, why I say that if you work with us is that is something that whenever I'm going through specific companies and providing data from a compliance standpoint, we do have to be careful as far as what we show and what we don't show. So with that said, we are going to provide some historical proof of performance today on different life insurance carriers, providing data that you may find very, very interesting. So in our last video, we talked about the four major mutual companies' 2022 dividend interest rates. And one of the big selling points I mentioned was point number 4, actual performance. We have seen, or I have seen to be so consistent, whole life insurance products that are properly designed. If it's not properly designed, this whole video goes out the window. Whole life insurance products with these four major mutual companies that are properly designed have delivered strong internal rates of returns to consumers. And this is a big reason why banks, corporations, and wealthy individuals use them, and anyone can use them. It's not exclusive to this group. The thing is, where's the proof of performance that these guys see that you can see? Can anyone see it? The answer is yes. The thing is, if you're in the business and you ever ask someone, an insurance company, for proof of performance, it's like pulling teeth. You'll either get no. Sometimes they play dumb with you and say, oh, do you mean dividend interest rate history, like the dividend history? Look at our illustration. Or they start to badmouth some other life insurance company. It's like, no. A policy that has simply lived the test of time. What did it actually produce? So we've got policies that actually date back to 1975, a Guardian policy. That one produced a net internal rate of return of just about 7.1%. But keep in mind, the policy was issued in 1975 and lived through a great dividend period. We've got the actual policy too. What I did was take all the data and put it on Excel and then actually just make it easier from the dividend interest rate standpoint and the annual internal rate of return. So here we've got an actual piece this is from a Blease report actually. You can find this online if you search it. We've got the full report. We've used it in past videos. A 20-year case study. Now, it's a little dated. It ranges from 1984 through 2004. It's on a 45-year-old individual. This is public information. People can find it if they look, both consumers and those in the business. It simply compares a number of carriers. The report or the study actually compared more than just who we have listed here. And I reorganized it on the left as far as the order. Mass, Guardian, New York Life, Northwestern Mutual. 45-year-old individual. Not a policy that is, or none of these policies are apples to apples. And that's a big reason I don't like this example. Meaning, when we look at the annual premiums here, they're all different numbers. It was all based on a $250,000 whole life insurance policy, and the premium was based on the insurance company's pricing. So no blends, nothing going into PUAs, nothing that we would actually want to do, which makes a big difference when I mentioned earlier talking about design. But what you do see here, 4 major mutuals, different premiums, actual cash values, and actual internal rates of return. What do you notice? All of them are well above 4%. What do you notice when you start to look at other carriers below? None of them are even at 4%. Here you have National Life, which primarily focuses on IULs today, just about at 4% with that old whole life insurance product, but they didn't hit it. These are actual internal rates of return. Now, you could be looking at this and say, okay, this is a bit dated, Steve, because it is, but this is one of the studies. I personally am not a huge fan of this kind of stuff because usually a company is going to show this report that looks the best on the report, meaning, hey, look at us compared to the competition. I don't like that. What I like are standalone policies. Here's one example of a New York Life policy. This was actually someone who is working with us, and he provided his New York Life policies. He was kind enough to do that. We studied the historical payments, what he made each year, and then 17 years into it, he's added a healthy amount of PUAs to the policy. His average IRR is just over 4%. That's net, and that was issued in 2003. This study was actually ran through 2020. So we've got to update it again based on an in-force illustration. Here's the present dividend rate, which now for 2021 and 2022, New York Life is at 5.8%, but still, this is the annualized IRR. We see that it's still performing. We'll be a little bit lower than this, but strong actual cash value performance. Difficult to find this kind of stuff out there. One of the major mutuals. If you were to look at, I'm going to pull this up via a PDF. We had to do this one a little bit differently because we had the statement. So this was a policy with one of your four major mutuals. The one company we cannot use actually because they only work with career agents, not independent brokers. Talk about them being Northwestern simply because they've delivered. Like you can't argue that they haven't when you look at them. Policy issue date, 1989, okay. What's nice about this is we have the total cash value. This was run from 1989 through 2017, the actual study period here. Total cash value, $22,329. The premium he paid was $420, that's it. Didn't add anything to PUAs, nothing fancy. So what we did, we go through this thoroughly in our historical performance case study, line by line. Just to make it simple, what he averaged out over 20 years, we just aimed for that same cash value of $22,003, we're just about a 4.63% net internal rate of return. Policy was issued pre-1990, so during a high dividend interest rate period, but still proof of performance. If we look at more recent policies, we see the same thing. Let me go back. Here's actually an all base policy that did not perform well at all. When we've seen, what I've noticed, and it's actually in the company's dividend formulas, it's all companies' formulas when you get to look at them. When you have a product with a higher base premium, or I should just rephrase, if you're paying any amount of money into a policy, the higher the base premium, the weaker the actual performance typically is. Because insurance companies can adjust their dividends, but really there's three things behind the actual performance of a policy. You have the company's illustrated dividend rate, but then you also have mortality charges and insurance expenses, all of which can be adjusted after the fact. So we go through this thoroughly in our case study, but all it validated here, we've seen this with a number of companies, is a policy, this was all base premium, but what was projected compared to what actually happened, world of difference. We've got the actual performance over here. This individual was very upset how we obtained this policy, because you'll notice it was issued in 2007. I was in college in 2007. I didn't write this policy, but he transferred it to us around 2017, 2021. Cash value is projected to be $437. It actually hit $391. And there was a period of time with this policy where the dividends actually had gone up when it was initially illustrated, but the actual performance came down. Agents can't explain that stuff typically. I had a hard time explaining that. You really got to dig in to understand why is this happening. And again, we cover that in our actual case study, which is not made public. But there's a policy that did not perform well. Here's a policy we actually put in force. I wrote this in 2014 with the individual. I'm going to update this. Fortunately, the company's dividend rate has remained the same. They just declared their 2022 dividend interest rate. Their performance has been spot on. Look at this. Here's the annualized IRR, continuously increasing over time, which is beautiful. That's exactly what we want to see. But 6 years into it, he's already well ahead of his break-even point. So here's a policy, again, one of the major mutuals. This one is specific to Guardian, performing quite nicely, and we've got a lot with Guardian that have done well. Here is, let me get to the next one. This was a fun case study. Look at this thing, right? All these charts. So this was a policy we actually put together, put it in place 2016, right after I got married. And this one's been a ton of fun. I thoroughly enjoy working with this individual. We tracked what the original plan was year over year. Here's the original illustration. And then on the right, what actually happened year over year. This is actually, again, with one of the big four. But we see the dividend rate has come down. It's come down with all companies. But at the same time, here's actual annual internal rate of return. I got to run the updated one, but the dividend rate has not changed for 2022. Their insurance expenses have not adjusted that much either. And this represents what he's earning year over year. So this is in 2021, his cash value grew a net internal rate of return growth 4.89%. This is exactly what happened. How we got this data is every year when I run the actual, when we have the actual review, it's based on an in-force illustration. I also reference the actual policy statements that are sent to him, but I can download those online as well. So we cross-reference everything, pull the exact dividend. Like that's what we've got. Like that is what is actually happening year over year. And then of course, as time passes, we crunch the average internal rate of return. My point is, what we've seen to be the case is when policies are designed well with the top companies, we see strong internal rates of return. I haven't seen it elsewhere. And as I always mention, that is not a shot at any other small company or nothing like that. Some companies are very, very proactive in trying to collect that data or striving to get there. And I appreciate that. Once we have the data from other carriers, we'll offer them as well. But again, the proof is there. And the reason why is this is people's money going into a policy where I saw so much stress and remorse from people and where people vent frustration with whole life insurance is when they get a policy, they are told or expecting that it's going to deliver and then it under-delivers. And they can't get straight answers as to why. So this is technical stuff. We went over a simple version of it today. It's technical, but here's the simple piece. This is why I'm so big on these guys as well. When we see well-designed policies, I should say low premium policies, high PUA policies with these companies, like we see the strong internal rate of return so consistent. Back to my days working at the firm where we designed policies for corporations, which was an independent firm. Not an IMO, FMO, nothing like that, which I've never worked for. When we designed policies for corporations, they always used the four major mutual companies. Those always came up in conversation. And again, the reason for that was not just because of the projections looking good, it's based on actual data. So I hope this one helped. This is always one of my favorite topics to talk about. I really like going deep as far as seeing the numbers and picking policies apart. But I hope you enjoyed it. If you did, please hit the like button, subscribe for more, reach out if you have any questions, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.